Okay, before we head in for the week, just some housekeeping announcement here. Discord running nicely. We've got about 2,000 of our subscribers in there now. If you have the applied level and you haven't clicked the link to join Discord, I strongly recommend that you do. I'm just going to point out two channels. The news channel. This is people from all different parts of the world posting news stories that you otherwise would not find in your own feed. I've now turned to this during the day as a source of news. I have Apple News, I have Wall Street Journal, Barron's. This now is sort of a go-to for me as well. And there's a research channel with people posting all sorts of interesting research. That is a gold mine. I mean, I would pay just for that channel. So if you have a subscription for the applied level, this is free. You can just click on the link within markmeldrum.com. Just navigate towards any video and you'll see it if you're looking at the screen. And here are all your applied options, applied asset management. Click on one of these, you get to the next screen where you have the list. Right over here, you'll see click on here to join Discord. Don't do yourself a favor. Click on that link. It is included with the applied level. Sunday night, tonight at 6 p.m. Eastern Time, which is where I am right now. That would be 4 p.m. Costa Rica time. I will be on the Market Outlook channel to answer questions, and right at 4 o'clock, which is again 6 o'clock. Globex goes live. Let's see how the futures open. Let's see where the currencies open. At this point in time, Bitcoin is suggesting a lower open for risk assets. So I will be doing a live on the Market Outlook channel on the Discord server. Anybody listening that has any CFA, FRM, or CIA status, you're a level 1 candidate in any of these or more, you do qualify for a $100 discount off of each module, off of either applied analysis or applied asset management, or both. So if you're picking up both modules, that is a $200 discount that you would get. Anybody that has any of that status at all gets a discount. Also, I am beginning work on the applied level app. We're going to create an app because there's a whole bunch of functionality that I would like in the app. markmeldrum.com has an app, but I don't own the IT team. So I can't say, do this, do that. They're not my team. I can ask for something, they can put in a ticket, and maybe if it benefits everybody, I might get something. But there's a whole bunch of other features that I want to put in there that I can't do unless I make my own app. So I am beginning the development of my own app. For YouTube, those of you who are just on YouTube that watch the Market Outlook regularly, first, thanks. I do appreciate the views. The comments section is going to end sometime in May or June. So comments will be turned off on YouTube. I delete 30, 40 of these scam comments every week of I'm making 8 Bitcoin a week, or who you listening to? I delete so much of that stuff. The bots are just ruining the comment section. So I'm going to end the comment section in May or June, and comments will only be in Discord. It's the same thing, except it's more dynamic. It's actually a better comment section. So how do you get on the Discord channel if you're not part of the applied level? You'll get an A1 role if you come to Discord. I will give you the role A1. Don't worry what A1 is. A1 just means you're from YouTube. It specifically says you're not part of the CFA program or the applied level, but you're from YouTube. Go to mm.com and just register for free. It doesn't cost you anything, and you will find all of CFA level 1 from 2018 there. Maybe watch a few videos. Maybe you say, hey, you know what, I can do this. The link will eventually be there. Not yet, but the link will eventually be there. A1 means that you can view all the comments that everyone else is leaving, but you can't add your own. I will allow A1 to comment with demonstration of certain qualifications. So there'll be, if you have this degree, or you have this standing, or if you're in second or third year university, just demonstrate it to me, and I'll upgrade your role. This is so that we can keep the conversation at a much higher level in the comment section, and try to get rid of, some of the, you know what I mean. I don't have to explain what I mean. You read the comments, and I'm sure you read some of them where you go, well, what was the point of even saying stuff like that, right? We want to eliminate that. So if you want to continue with the comments, if you want to be able to watch the live Q&As that I do on Sunday night, you will have to be on Discord. The only pathway there right now is mm.com. Register for free. Enjoy the 2018 Level 1 content that is there, and in a month or so, there will be a link for you to join Discord. And then a little while after that, I will have a bot that will be able to upgrade you with a demonstration of some qualifications. Okay, let's head on in. This is going to be my last market outlook from Costa Rica for a while. I'm done here today. Today's Sunday. My flight leaves back to Canada on Monday, 7 a.m. So for the next 5 or 6 weeks, I'll be doing it from Canada. Let's begin this week with a review of what we saw last week, CPI and PPI, and I'm not sure it's reflecting a lot of the changes that we are expecting from the rebalancing of global trade. CPI, all items, 0.2% for February. I've calculated to 3 decimal places below. Headline, month over month, 0.216. Year over year, 2.81. Core, a little stronger, 0.227 month over month and 3.14 year over year. And supercore, this is removing shelter. Once we do that, we see that, you know what, it's not really much of a problem in the CPI. You have 0.182 month over month, and you have 2.22 year over year, basically at target. Let's move over to PPI. Because there we have a sort of a bigger story. This is final demand for goods and final demand for services. I keep hearing that PPI is what wholesalers pay each other, or what's in the value chain, but not the consumers. That is not true. PPI is just the other side of the counter. It's what, when you're looking at final demand, it is what the businesses receive from the consumers for goods or services. CPI is what the consumers give the producers for final goods and services. It's just the other side of the counter. Let's look at demand for goods, 0.3. Food and energy, look at food, 1.7. Energy, negative 1.2. You have 0.4 on goods. Tariffs have been showing up on goods, not services. And the anticipation of tariffs are on goods. So you have a lot of, and we've seen this in the import-export data, a lot of front-running from businesses to get goods imported into the country before the tariffs hit. Well, that is going to keep price pressure on goods. Let's look over at services, see what happened there. Negative 0.2. I think a damaging number here is under trade. This, when we talk about trade, we're talking about margins, negative 1%. So we're thinking about corporate profitability and margins for profitability. That number reflects the potential on that. Transportation, warehousing, flat, and other 0.2. So you actually have overall for what the businesses are receiving from the consumer for services, we have deflation in that particular month. I've also made a note down here of headwinds and tailwinds for pricing pressure. A headwind for pricing pressure is obviously tariffs, because as the good comes into the country, 25% or 10% or whatever the number gets put onto that before it makes its way onto U.S. soil. So it is an increase in the price of a good as it crosses the border into the U.S. If that is passed along to consumers, that is a headwind on getting inflation down, or a headwind to disinflation, or you could say it's a tailwind to inflation. I'm thinking of it more in terms of the progress we want to make towards 2%. It's a headwind for the economy to get to 2%. Also, we've seen a weakening U.S. dollar. Dollar index fell quite a bit, some 5%, since Trump has been in office. As the U.S. dollar weakens, imports become more expensive. Now you take those expensive imports and you put another 25 or 10 or 25% on it in terms of tariffs, that becomes even more expensive when it lands. Tailwinds, what is helping get prices down? Lower international demand. If you are putting tariffs on other countries, we have seen other countries retaliating by putting tariffs on the U.S. That will lower the demand internationally for U.S. goods. And it's not just government tariffs. It's shifting, businesses shifting their supply channels to other sources of supply, and consumers deciding in the department stores and malls and grocery stores to buy something non-U.S. as opposed to buying U.S. That is going on. That does have an effect. That does lower the demand for U.S. produced goods. That is a tailwind supporting disinflation. You end up with greater domestic capacity when you have that. If you end up with greater domestic capacity, you end up with more supply than demand in the domestic market, which is deflationary. Technology. I've always said this, even before the trade wars, that I'm not that concerned with inflation running away at this point, as if you fix the supply channels, technology will take care of the rest. And the backdrop, I think, of the global system is deflationary. Technology and technological advance is deflationary. And Doge, if you're cutting expenses, those expenses, every dollar you cut was somebody else's revenue. Every employee that you get rid of is a paycheck that no longer finds its way into the economy, unless they get another job somewhere else. But you are eliminating some form of aggregate demand if you're not giving the money, transferring the money, spending the money. You are eliminating some form of aggregate demand. And the cure-all is a recession. And on this recession, there is some thinking that, at least I've heard out there, some analysts are saying, you know, this is all going according to plan. The plan is to cause a recession to force the central bank to lower interest rates to zero so that that you can refinance the debt at lower costs, so that you can start working down that debt. And put tariffs in place to generate revenue, start paying down the debt. That this is all part of the plan, and to force the Fed's hand, you need a recession. I don't think that's part of the plan. I think a recession will be marketed from the administration as part of the plan. This is what we're doing. Look at what we're doing with prices. Some adjustment, painful adjustment, is necessary, but a recession is a cure-all. If you want to get prices down, if you want to bring not just disinflation, but actually prices coming down across the board, that meaning deflation, nothing does that like a recession, especially a deep recession. How do you get a deep recession? No fiscal support. If you have Doge, which is looking to cut all expenses, and you head into a recession, don't look for big spending bills. So you will lack the fiscal support that other recessions have had that made it less painful. If one comes this time within a tariff war such that other countries enter a recession at the same time, if you're looking at a global recession and there is no U.S. fiscal support, it could be very bad, which means, yes, you could solve a lot on the price level. You could lower prices a lot, but unemployment of maybe 10, 11% would be the cost of getting that done. On this screen, this is data from the last reading for consumer sentiment from the conference board. It's important to pay attention to this lately. It is both Michigan, University of Michigan consumer sentiment and conference board. I said consumer sentiment earlier, consumer confidence. They use different words. Do have an effect on what we would expect to happen going forward. If we expect tough times going forward, we become more cautious as consumers. So it is a read, not so much on the consumer today. It's not a coincident indicator, but it is a leading indicator. Let's look at present situation up here, and we have expectations 6 months from now. Present situation. Well, isn't that bad? Assessment of current business conditions. 19.6 conditions were good, up from 18.5. 15.7 said they were bad, up from 15.2, so they both increased. And if you're wondering why it doesn't add up to 100, because many other people say, it's about the same as it was before. It's neither better nor worse. Labor market, 33.4, jobs were plentiful, down from 33.9. And 16.3, jobs were hard to get, up from 14.5. So incrementally, jobs are less plentiful and harder to get, incrementally. This is probably more damaging here is the expectation 6 months from now. I mean, I could have a job today. I could say, no, I have a job, my income is good, but I'm a little bit worried 6 months out. That will cause me to start pulling back today. Business conditions, outlook for business conditions. This is current situation at the top. This is expectations out 6 months from now, 20.2. Expect conditions to improve. That is down from 20.8. This is the big jump, 26.7. Expected them to worsen, up from 19.6. That is a big jump. Pessimism about the labor market, 18.4, expected more jobs, down from 19.1, so fewer people are expecting more jobs. But look at the jump you have, 25.9. There'll be fewer jobs, up from 21% in January. That is a big shift in 1 month in terms of business conditions and in terms of the labor market. So at the margin, that is going to begin to reduce aggregate demand, because a lot more people will get a lot more cautious. You would expect that this will show up in things like housing and durable goods first before it shows up in the malls, but it would show up there first. Why would I get a new refrigerator, a new washer and dryer? Why not wait a few months to see if things change? Because that's a big commitment, especially if I'm going to use any kind of consumer financing to get that done. Less optimistic about their income prospects in February, 18.2. Expected their incomes to increase, a slight uptick from 18.1. 13.7 expected their incomes to decrease, up from 12.3. So you have an extra 1.4% on average that is going to say, well, if I expect my incomes to drop, I'm going to be a little bit more careful with my income now. You have 4.9% more people saying, I think there'll be fewer jobs 6 months from now than there are now. That's lower pressure on wages. Because if you think there'll be fewer jobs, you're not willing to quit your job because you're not getting the wage you want. You're less willing to push really hard on that. So as far as expectation, this adds to everything else. When I get to talk about my expectation for beta and where I see that going, I'm quite negative on beta. And not because of any one thing. It's because of all of these little things that you add up. Okay, let's have a look at rates and yields. Pretty much nothing to see here, nothing exciting across the yield curve. Look at the capital market curve. You've got just a bunch of zeros here and 1 basis point move pretty much right across the curve. Nothing much to see in money market rates either. We do have FOMC in 3 days. The probabilities have shifted very heavily to nothing happening. I think that's right. I don't expect anything to happen there. We still have a curve inversion, although small. You could say, well, that's not much to talk about. That's not conviction. That's just a rounding error, right? But it still is a curve inversion from the money market curve to the capital market curve. You can see week over week, hardly any move at all in the curve, almost the same curve we had before. When we get to credit spreads, different story. Man, is that starting to move. Retail sales, we get in 1 day. That'll be retail sales for February. I'm not sure that it's going to reflect the expectation of or what we would expect going forward. I think it'll still probably be quite strong with a lot of purchasing before tariffs show up. At least that's if I had to pick stronger or weaker, I'd probably be more on the stronger side. Canadian CPI in 2 days, I don't think it matters. I don't think it's going to change anything. Bank of Canada cut rates by 25 basis points. We are in the middle of a trade war. Carney is now our new prime minister. I think this is our first time in Canada that we now have an unelected prime minister. Unelected, when I say unelected, this is not somebody who won the Liberal leadership, who was already elected to a riding in Canada, who had already won an election and was already part of the Liberal Party. This is somebody from completely outside who didn't run for any election anywhere and is now prime minister, an unelected prime minister. And it seems that Carney is all set to square off against Trump, not siding with him, saying, no, this is a trade war, period. And we'll see if he pivots away from the left to the center and becomes more of a classical liberal. He did, which I was quite impressed with, cancel the consumer carbon tax, something the Conservatives were campaigning on, saying we will kill that tax. He's already done it, sort of taken away one of their big campaign promises. So he's already done that. So that is like, okay, all right. Can the Liberals become classical Liberals again? Now, that is a question. If they can, I got no problem with that. I did have a problem with Trudeau's form of liberalism. That was not good. Anyways, Canada CPI in 2 days. I just don't see it as being important, given that we are in a trade war. The reverse repo, 126 billion hanging out there. Reserves kind of jumped up, I guess, with a 10% drawdown in the S&P and a not a hate, but an indifference towards U.S. Treasuries. Maybe some money was just left in cash. Just let it sit there. So reserves are a little bit higher in the system. So looking at 27 months at 40 billion a month, but I do think it is going to be a topic of conversation, or at least I think it should be a topic of conversation in the press conferences. What are your plans for slowing down the balance sheet runoff, and what are your plans for the MBS portion of your balance sheet? We got over $2 trillion of mortgage-backed securities, and the Treasury would like a lower 10-year. Is there a marriage there? Is there a deal to be done? What's going on? I would be asking the question, so I'm sure somebody somewhere is going to be asking that. Week over week, TLT pretty much unchanged, as we see from the curve itself. SPX did not have a good week, down 2.27. It did finish Thursday night in correction territory. It is official. You have had a correction on the SPX, and then you had a rally the next day, which I think is simply just a rally off that correction point. I don't think that we're looking at any kind of V-shaped recovery on the index, which we've always had. We sell off and then we go right back up. I don't think we go right back up. I think that was a technical bounce off a very critical level. How long have we been waiting for 10%? You get 10%, buyers come in. There we go. There's our correction. Now, I don't know that really has a lot of legs. I'm looking at Bitcoin. Been watching it all weekend. And it is negative, down like 1,400, 1,500 as I do this. And I know that some of you may say, oh my God, he's watching Bitcoin. Bitcoin has a very good correlation with risk. Bitcoin is not digital gold. Gold is gold. And if you've seen the price of gold lately, gold is shining, isn't it? Gold is gold. Bitcoin is digital. Drop the gold. And I wouldn't even say Bitcoin is a digital asset, because it's not an asset. Bitcoin is digital risk. Now, you can get that risk exposure and get a return, but it is not an asset that is giving you the return. It's just pure risk. But it has been very good at determining where the futures would open. You go into Sunday afternoon, 5 o'clock, 6 o'clock, New York time, when Globex opens, Bitcoin is red. Futures, you can count on futures pretty much being red as well. And Bitcoin is negative by over 1%. It seems to have a beta of almost 3. So at 1.5%, as of now, I would expect that that is consistent with futures opening down 0.5%, which would put it down about 28, 29 points on the index. As a, on average, it would put that down. So that's where we are now. SPX did not have a good week. I don't expect it to have a good quarter. I don't expect it to have a good year. I think the highs that we saw earlier in the year on the belief that the equity market was going to get nothing but good news, and all the good news was going to the equity market, I think that is disappearing. And the Fed funds futures is now solidly pricing in more than 2 cuts. For a while it was 1, then it was 2, and I thought that was too little. 3 is probably more realistic. I think it's going to be more than that. But we have 65.5 cuts being priced in, sort of 2.5 rate cuts. Last week we had 3 rate cuts being priced in 7 meetings because 1 is already gone. I don't expect any move on this one, so really we're looking at 6 meetings. So 2.5 rate cuts over 6 meetings. I think if the administration stays on the current path they're on with their tariffs, and they go ahead and they implement the reciprocal tariffs on April 2nd, and other countries begin to retaliate as well, if we stay on this path, I think it forces the Fed to have to cut more often, because that is in the end a lose-lose situation for everyone. You have the very real prospect of a very bad global recession, and I will lay out a case in a little while where you would have a much more severe U.S. recession, that you would have a global recession with the U.S. suffering the most in that recession. Let's look at some other rates and spreads. Real rates, not much to see here. 4 basis points, 3, 2. It's not much to talk about. Same with break-evens. They haven't really moved that much. Big story here is in OAS again. This is the move week over week on the spread for investment grade. Widened 10.23%, high yield 13%. Double A 13%, triple B 10%, almost 15% on double B, another 10% on triple C. In red is the tightest the spread has been, and that was anywhere from 3 to 5 weeks ago. Some of this was late January, some of it February. You're talking about in a span of 3 to 5 weeks. You've gone from 79 basis points to 97 on IG, 2.59 to 3.4 on high yield, double A, widened by 14 basis points. That is roughly about a 33% increase from the tightest spread of 0.44. You're at 0.58, 98 to 1.2 on triple B, 156 to 217 on double B, and 690, almost 200 basis points wider at 872 for triple C. Still, if we look back historically, still rather tight spreads, but to move that much in 3 to 5 weeks, that's a big deal. So this is now that, for 2 years I kept saying, nothing to see here, folks. So move along. There is a lot to see here. We're going to be watching this every week. With that, let's look at corporate bond issuance. Year-to-date down 13.4%. January, February of 2025. The issuance is 13.4% lower January than January and February of 2024. Here's February down here. Last year, investment grade issuance $200 billion down to 157. High yield $28 billion down to a little under $24 billion, and convertible $7.75 billion down to $5 billion. With again, the current path that the administration is on, if there is no deviation on that path, no change on it, and with consumer sentiment sort of turning down the way it is, I don't know that now is the time to take on debt for new expansionary products or projects. There is the rolling over of debt, but look at what's happening in the last 3 to 5 weeks in just the credit spreads. That rolling over is going to have to be done at a much more expensive spread. So I would expect that this would tend to drop over time if we stay on this current path. Mortgage rate 6.65 on the 30-year fixed rate. Hardly any movement. We had widening of that, or an increase in the yield of that, 2 basis points. Year over year is really telling. Look at this 1 year change, only down 9 basis points over 1 year, but there was a lot of volatility within the year. For housing, XHB, the two ETFs, XHB and ITB, both in bear market territory from their highs. We'll just call it the 52-week high because it was within the last 52 weeks. XHB down 22.3, ITB 26.2. The two biggest home builders, D.R. Horton and Lennar, well in bear market territory on their stock. Almost 36% on D.R. Horton, 33.7 on Lennar, and Lennar has earnings this week. So maybe with earnings, they can say, no, we're number one, and be down lower than D.R. Horton. I don't know that they could be raising guidance and raising excitement going forward. What typically suffers when consumer expectations turn down, especially when you have an elevated 30-year fixed rate mortgage like this, what usually turns down first, or what usually gets pulled back on, is big ticket items that require financing and consumer durables, appliances and things like that. So I don't know that anything that's going on right now is a tailwind for housing. It still looks like significant headwinds right now. So to ask the question, is now the time to get into housing stocks? I wouldn't. And they're not on my radar, and I'm not looking at them. This is just not the environment to get into housing. If we believe that this trajectory we're on is going to remain and that a recession is more than likely because of this, I would not look to add housing until you get some kind of recovery out of that recession, which could be 3 quarters, 4 quarters, a year and a half from now. So are any of these on my radar? No, they are not. On to SPY. On Thursday, we did, with the close, print an official correction on the S&P 500, but just, and then of course Friday we had the technical bounce off that level. 612.30 for all-time high, 551.07 is a 10% correction. Thursday did give us that finish. After Friday, we are now down 8.2% on SPY. IWM and IJR are not doing too well, down 16.2% and 17.15% from their most recent highs. They did on Thursday flirt with bear market territory. It looked like they were approaching bear market territory. This technical bounce saved them, but they're not that far off from bear market, which is down 20%. The forward 4-quarter operating earnings sitting at 270. We haven't seen a deterioration of that. What we have seen over the past week is almost every analyst with a year-end target for the S&P lowering their year-end target. But still, many of them higher than where we are right now. I think the most surprising one was Ed Yardeni. The Permabull lowered his year-end target. That is, for him, as bearish as you're going to get. lowering your target to be some 17% higher instead of 23% higher. That's a pretty big deal. I do expect that these will come down over time. Closing SPX 56.38 gives you 20.86 on the forward multiple. Still, close to 21. That's still a rather rich multiple. That if you think 19 seems to make more sense given the level of uncertainty that we have, and given the pathway that we're on, which sort of makes it seem like, if we stay this way, a recession seems like it's the most likely outcome later this year. If you put 19 times 270, or what, 5170, or 517, we're at 562. So you still have some downside to get there. And if you have earnings coming down, you will have that multiple also coming down. So if you think that earnings might drop to 240, Just for exercise, you put an 18 multiple on 240. You're below 4,400 on the S&P. You could get another scenario like you had after the dot-com crash. You had a market crash, but the economy, as far as a recession goes, it was a blip. Retail sales continued to rise through it. It didn't really feel very much, but it was generally a blip. But NASDAQ lost 90% of its value, and S&P started a slow bleed over the next year and a half, 2 years, and lost, I think, 55, 60% of its value over the next 2 years on a slow bleed. I think you could probably see the same thing now. It doesn't, unless you get a big global recession, which in the next screen I'll talk about, is there a pathway for that? And there certainly is. But if we get this tit for tat, tariffs on, tariffs off, this what appears to be a plan with no plan of execution, but this is what we want to do. Here's our strategy, but we have no plan of execution. If you get that going on, I mean, you could see a slow bleed. Imagine if you had a repeat of that and some 50% drawdown over the next 2 years, from 612 down to what, 306 on SPY or 3,000 on the index. That would not be fun. Where'd I leave off? Here we are. Implied volatility still elevated on SPY, but it did come down a bit based on the rally on Friday. TLT still elevated. Implied volatility on SPY down a little, 19%, down from 20. This is the IV last 30-day IV, and for TLT 14.6 up from 14.5. Open interest really came down on both TLT and SPY. We do have some earnings this week, not many. Both agree. Both of them are correct this week. Some of note: Wednesday, General Mills; Thursday, Micron, Lennar, and Darden Restaurants, with Micron and Lennar being the two big interesting ones there. Friday, you have two interesting ones here: Nike and FedEx. What kind of guidance is FedEx going to give? If you have lower levels of international trade, if you have lower levels of consumer spending because the expectation of the future is going to be negative, FedEx is a leading indicator of all of that. What are they going to say? I think that is something to listen to. And Lennar, that'll be interesting to listen to. So if you're not going to do any earnings calls this week, I would seem to think just for entertainment purposes, you'd want to listen to Lennar's conference call, and you'd want to listen to FedEx's guidance on both of those. I think are going to be critical. Let's look at the strategy that is being followed with these tariffs, and we'll try to think out sort of, what pathway we seem to be on. Okay, here I'm going to lay out two broad scenarios. The U.S. imposes tariffs. And scenario number one, the target country does not retaliate. Scenario number two, the target country does retaliate. Trump is using a particular type of language. If they charge us, we're going to charge them. And when we talk about tariffs, it's not really the correct language. The correct language is, if they're going to charge their citizens more for our products, we're going to charge our citizens more for their products. How can we get to the statement, we're going to make them pay, that they pay the tariff? There is a narrow pathway by which the target country would be paying the tariff, and they don't pay it with a cash payment. They pay it with a loss of their purchasing power. So it is a wealth transfer in terms of the adjustment of the currency for purchasing power. Let's look at a scenario. And it's a very narrow scenario, by the way, which requires a very particular approach to tariffs. And if you do this, you can make it work. But there are two very strong conditions for it to work. The target country does not retaliate. And by retaliate, we mean all sectors of the economy. Government does not retaliate, business does not, and household does not. A household retaliating is saying, I'm not going to buy the U.S. product, I'm just going to buy domestically. such that demand for the U.S. product incrementally decreases because of that. That would be a form of retaliation. You would have to have no retaliation. What would happen more than likely is the currency in the target country would depreciate against the U.S. And in the perfect outcome, it would depreciate to offset the tariff such that the final U.S. price is unchanged. So if the U.S. is importing something and a consumer pays $20, and the U.S. says, well, 10% tariff, we'll put $2 on. If there is no retaliation, it would be expected that the target country's currency would depreciate such that this is no longer 20, but is 18, with the tariff would then result in 20. Well, actually, it would drop to 18.20, and 10% of that is what, 190 or 180. So it would end up being that there'd be an imperceptible change to the consumer. Wouldn't show up in measures of CPI or PCE because the currency adjusted. If the currency adjusts, what happens is the purchasing power of the households and businesses in the target country would decrease because their currency is weaker. Anything they import would cost them more, and thus that lowering of the real purchasing power, the real wealth, would be a wealth transfer to the U.S. However, you need two very strong conditions. You have to have a trade deficit with the target country because you are reducing their purchasing power. So if you have a trade surplus and you reduce their purchasing power, you're actually taking away the demand for your own exports to that country because now they can only buy less because of the depreciation of their currency. So you must have a very clear trade deficit with that country, and there is no retaliation from any group. You've got a pathway. How do you get that done? You got to sneak up on them. You got to do it gradually and diplomatically, 2%. And you open a conversation saying, look, it's going to be on certain things that we feel are in our best interest or national security. It's 2%. On average, our tariffs in the world are 3%. Everyone else is 9%. I mean, really, we're just catching up. If you did it diplomatically and gradually, there'd probably be no adjustment and no retaliation from anywhere. And take Canada and the U.S. 2% done selectively. Canadian consumer would probably not even notice, and 2% would say, so what? Wouldn't change anything. And it's done diplomatically. But this is not being done that way. It's being done all at one time and belligerently. By belligerently, I mean they're ripping us off. They've been treating us badly. No one likes to be called a thief or a criminal. They're ripping us off. They're treating us badly. We're going to show them they can't continue to do this to us anymore. And then the talk of we're going to take this, we're going to take that. Canada doesn't work as a country. It only works as a state. Now you got retaliation. Not only do you have government retaliation, but you have businesses that are going to find new customers for their products, and you have consumers in the shopping aisle saying, I'm not touching that. By some estimates, the consumer retaliation, just that alone, exceeds the retaliatory tariffs on goods that the government has already put in. And we can see the Canadian dollar from the beginning of the year, or at least from the beginning of Trump's term to now, has not depreciated against the U.S. In fact, we can see that the U.S. currency has depreciated on a trade-weighted basis against most of its partners, which means the U.S. is actually paying the tariff and is paying three different ways. It's paying the tariff on the way in. Its currency is lower, so whatever they do import is now costing more U.S. dollars to begin with, and you have retaliation outside of the tariffs as well. So this pathway is off the table. If it were done in Besson's way, if it were done incrementally and gradually and diplomatically over time, there was a pathway. But it was a 3, 4, 5-year plan. And what you have with the current administration is not Team America. They're not going to set this up for the next administration to say, hey, we can claim victory. Not if it's a 3-year, 4-year, 5-year plan. It would fall into the next administration. This is not Team America, this is Team Trump, and Trump must win on this one. So you have it all right away, and in Trump style, you have it in a very belligerent way. So this is off the table. The idea that the other country will pay, that's off the table. Let's look at what happens when the target country retaliates, because Canada has retaliated and the Canadian consumer has. Europe has retaliated, and I put the question out there, is anyone changing their buying patterns in Europe? And I've had some people here in the last 3 weeks who are from Europe and saying, yeah, they are paying particular attention to that. So the household sector is retaliating on top of the retaliation from the government on tariffs. And you have the U.S. opening a trade war on way too many fronts. You can't win that. The U.S. will suffer just as much as every other country because it has to suffer the sum of all the retaliation. Canada has to suffer because of the U.S. tariffs, and it will hurt Canada more than the U.S. on that one front. Same with Europe. Europe will hurt more than the U.S. on that one front. But you add up all the sum of those fronts for the U.S., it will hurt just as much as everyone else. You get a recession, a global recession on this, if you get no fiscal support from the U.S., but you do get fiscal support from other countries. We're seeing that Germany is amending its constitution such that it can spend. Canada, debt situation compared to GDP is far better than the U.S. right now. So it can deficit spend in a recession. You get other countries willing to deficit spend in a recession, and you get no fiscal support from the U.S. It could be far worse in the U.S. than it is in other countries. Now, if I'm an advisor to governments, I would advise a certain thing. And I'm not the most clever person when it comes to international trade, so I know there are other clever people out there probably whispering the same thing in every leader's ear. Listen, what all you countries need to do is get together and drop your retaliatory tariffs altogether. And instead of that, have export quotas or have export taxes such that the Americans pay yet again, but allow all the American goods to come into your country without any tariffs. Don't charge your citizens, but make Americans pay even more than the tariffs they put on. And if they unite and they do that, the U.S. cannot win a war on that many economic fronts, especially if the rest of the world is willing to deficit spend in tough times and the U.S. is not. That can end up very badly. Let's look at the most likely path, and the one that I believe is the path that we're on until I see something different out of the administration. I think this is the path we're on, and I would position my portfolio for this pathway. The effect on the currency would be uncertain. Maybe some currencies will strengthen, maybe some currencies might weaken or stay the same, but it's not clear. What is more likely clear is that the U.S. dollar index on a trade-weighted basis would feel the pressure. But I don't think to the level of purchasing power adjustment. But it would feel it, but not to that level. Import prices would rise in both countries. Domestic substitute would also have price increases as well. So let's see if I can give you an example of this. The U.S. is importing something from Canada. Well, now it has a tariff on it. So the importing business or the importing consumer would pay a higher price because you're not getting the purchasing power adjustment. Whether it pays 20% of the tariff effect or 60%, again, is uncertain because we don't know the effect of the currency adjustment, but it would be paying more. It may induce the American consumer to say, well, I'm just not going to buy the imported product. I will switch to a domestic substitute. But the consumer could have switched to a domestic substitute at any time. The probable thing was they were using the imported good or service because it was the less expensive one or the better quality one. So now they're going to switch to a domestic substitute, which will either be lower quality or higher priced, because they could have always done that. And if the domestic substitute were the competitively superior product, they would have already had done that. So more than likely, domestic substitute prices would rise, import prices would rise in both countries. The extent of the price increase would depend on the currency adjustment, and the currency adjustment would not adjust to purchasing power parity, meaning both countries would suffer on this. Export prices, U.S., Canada. The U.S. is exporting something into Canada. Canada is exporting something into the U.S. It would create lower demand because right here you have tariff, and going into Canada you have a tariff. So the receiving party on both sides would say, well, now that the tariff is here, I'm not that into it. So at the margin, it's going to increase demand for exports in both countries. Would put downward pressure on export prices in both countries. It would also create domestic overcapacity. Let's take a business here where it's 50-50. 50% goes into the domestic market, 50% goes into the export market, and it employs 100 people. And you have a tariff. Well, more than likely this would be reduced. At the margin it would be reduced. Let's say it gets reduced to 30. That means domestically 70 would be sold. That would put downward pricing pressure on the 70. And what would more than likely happen is your workforce would decrease by a certain percentage, as opposed to selling something, creating a glut and hurting your margins. You'd probably just right-size your labor force for that. So in the end, you'll end up with domestic gluts. You'll end up with deflation for that particular product or service. More than likely, it would be job losses. And again, even if a country retaliates, it could still benefit the U.S. only if a trade deficit exists. And you cannot just look at the trade deficit. You can't just say, well, there's a $200 billion trade deficit. Even if you retaliate, you have to consider all of the non-tariff retaliations, what is the change in behavior of households? Because if households change their behavior and overwhelm that trade deficit by more because of the change in their behavior, it would only hurt. It would only make a trade deficit worse. So less benefit. It only benefits if a trade deficit exists. That benefit starts to disappear if both households and businesses retaliate. And if they overcome the amount of the deficit, it could end up making a trade deficit even worse. This is where we are. And if it were against one country, you could sort of side with the bigger country and say, Canada can't win a war, a trade war with the U.S., and that's true. But I don't think Canada's trying to win a trade war. Canada's just trying to break an arm or break a leg. I've made this analogy before. If you are faced with the very real prospect of a fight with somebody that you cannot beat, your job is not to beat them. Your job is to get a knee, an ankle, a wrist, an elbow, a shoulder, anything, and focus all of your attention and break one thing. That's your best hope. That's your best hope against a superior fighter. Against a superior force, that is your best hope as well, is to get in there and focus on one or two key sectors and break them. And if Canada does that, and Europe focuses on one or two sectors and attempts to break that, and China focuses on one or two sectors and attempts to break that, well, somebody's gonna get lucky or good or skillful and break one thing. And once you break one, you can begin to break the others very quickly. I think that's the path we're on. I am negative U.S. beta at this point. I cannot see, just with never mind the government retaliation, just the consumer backlash at the way this is being done, at the belligerence that it's being done, I cannot see how American brands are going to be increasing their sales, especially international brands are going to be increasing their guidance and increasing their sales in the face of all this. I can't see, with the US dollar index dropping, how the American consumer is not going to pay the price of this. Here is a couple more scenarios that I can lay out, because we're dealing with a lot of smart people who are going to be involved in this. It's not as if they don't know what they're doing. It's not as if they don't have good advisors. It's not as if they don't have their own team of economists to advise them. Now, I can conceive of a response that is more damaging to the U.S. I am absolutely certain every country has this as their option as well. And my advice would be this to every country out there. Drop your tariffs. Drop your retaliatory tariffs right now. You're not going to win on that, and you're only going to hurt your own citizens on this. But you cannot not respond. You have to respond, but this is not the way to respond. Drop your tariffs so that you don't hurt your own citizen, and instead put export quotas or export taxes on stuff leaving the country. Make the U.S. pay double. They put a 25% tariff on a product leaving your country, throw another 25% export tax on it. Your citizens don't pay anything. Don't allow your citizens, don't make your citizens pay anything more for the U.S. product. Let them have whatever they want. But put the tariff, put the export tax on the product leaving, and now Americans have to pay 4 times. They pay for the tariff, they pay for the export tax, they pay more because their currency is lowered, and you also have the non-retaliatory tariffs based on the consumers and businesses boycotting U.S. products and services. That is what I would do. And that is collectively how you would win. Because I can conceive of it, I see that as a likely outcome. I see that at some point, some country will say, no, we're not going to do this. We're going to do this instead. And then you're going to get other countries that follow along and say, yeah, that seems like a better thing to do. We're going to do that. And if you get that concerted effort, the U.S. can only lose on this one. The U.S. is on a path right now of isolationism. Not just because of the tariffs that they're imposing, but in the way they're imposing it and the language that they're using. And with a transactional president, more and more countries are coming to a conclusion, rightly or wrongly, it's still a conclusion that they come to, that the U.S. has become an unreliable partner, that the U.S. has become an untrustful partner. And trade will find a way around the U.S. The U.S. will rebalance their trade, but not with a good outcome. I can't comfortably be long beta. I see, if not a crash in equity prices this year, I think a bear market is probably more than likely for small caps. If we continue on this in a recession, you will have a bear market in large caps. But if you escape a recession, you are going into a lower growth regime for the globe. No, there are no winners here. There are just losers. I'm not going to point to one country and say this is the winner, that's the winner. This is just lower global growth and probably a slow, under that scenario, a slow long bleed on the S&P. So I am, as of Friday, I got as neutral as I possibly could on my beta. So I am long and I am short. And we'll see what happens as the week unfolds. We'll see if the U.S. is willing to change course, willing to change its rhetoric, willing to change its strategy. I'm skeptical of that. It's not consistent with the administration and the path that they've taken so far. There are some that think that this is all intentional, that this is not a mistake, that the intention is to cause a recession. Because if you can cause a recession, you can get the Fed to lower rates to 0. And if you can do that with all of the debt that you have to refinance in the next year or two, you can refinance that at extremely low rates and start to improve the budget deficit by reducing the amount of interest expense that you have to pay. So there are some that are saying this is going according to plan. This is, in fact, the plan is to create a recession. And if it is the plan, job done. Well on the way. If you believe that is the plan, then a recession still lies ahead. You must be negative U.S. equities. You must. and probably positive duration for at least a while, because if the goal is to get that yield curve way down, duration is going to be the big winner. And if you believe, yes, in fact, as Jim Bianco has put forward, that this is the goal, this is the plan, this was the strategy all along to cause a recession. We're not in the recession yet, and we're down 10%. Where are we going to be with the recession? A recession without fiscal support, a recession with a global backlash against international brands. Where is that recession going to end up? So, if you don't believe that this is the goal, that this is an unintended consequence that nobody really cared about, we have two things. Either Trump will sit in the White House and think, okay, this is not what I wanted at all. Let me declare victory and change. Let me declare victory and say, we got what we wanted, let's pivot and change right now. There'll still be some residual negative sentiment in other countries, but that could avoid the recession. Or he could just double down and say, I'm not changing anything. Yes, this is an unintended consequence. We'll just say there'll be some adjustment that needs to be done, but I'm not budging. They will budge. They will drop their tariffs. As he, in his mind, thinks, how dare they not let me win this easily? Don't they know I'm trying to win? Right? Anyways, that's what I have for this week. I think the pathway to other countries paying the tariffs, that is closed. The U.S. consumer is, to some degree, if not total degree, if not even more than total degree, paying the U.S. tariff at this point. So I am going to continue to be negative on beta until I see a decisive shift away from that. But I do think the highs for the U.S. dollar index are in. I do think the lows for corporate spreads are in. I think the high for the equity market are in. And gold, I don't think the highs are over for that. I think gold goes much higher over the course of the year. I think the U.S. dollar index goes much lower. I think equities go lower. The multiple, I think, goes lower. And I think earnings estimate goes lower. And the winner, at least in the near term, I think will be duration for the year. The highs for TLT are not in. And that's it for the week.